welcome to the Possible Promise podcast. Every Monday and Friday, we go live at 12 p.m. We go live at 12 p.m. Eastern to break down the complexities of finance and point the way to financial success. Today is June 15th, and I am your host, Brandon Oliveris.
And I'm Christine, his wife.
This is episode 3, an utter failure, the anatomy of an option. Alright, well, thank you for dealing with our intro. That was an utter failure. I accidentally hit mute when I was in the middle of talking.
And then you can tell it's Monday, guys.
And I was all proud of a really smooth intro. I got the music started right away. I got us talking when I was supposed to talk. And then I hit mute. I'm like, oh, great, I can't rewind that. And then I say, I'm Brandon. And Christine's just like, la, 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 la. I don't have anything to say. So, welcome to our very dysfunctional podcast.
It's okay.
At least I got the episode number correct. That was good.
Yeah, I was like, wait, are we on 3?
Yeah, we're on 3. They were definitely on 3, so that's good.
And it is 2020, in case, you know.
Well, yeah, I forgot that part. I don't care, whatever. It's alive. And
I don't know if you
matter.
ever say 2020, though.
I don't know. I have to check back. Now I don't know if I did, and it's bothering. We'll get this thing figured out. So...
it just proves that we're human. It's okay.
Yeah. So, welcome to the podcast. If you are listening to this later on as a recording, we do this, like I said, every Monday and Friday. I realized I hadn't been really giving the address where you can tune in. Oh, that's what I missed in the intro. You can tune in when we're live at possiblepromise.com/live. So I think I included the intro a couple times, and then I forgot a couple times. So we're messing with what's in the intro and kind of just trying to figure out what we're doing.
Yeah,
so,
I didn't even think about that.
Yeah,
actually.
well. But if you are live, then welcome. And if you're listening to the recording, then that's cool too. And today we have a lot to talk about. We're going to talk about options later on. But before that, in a little while, we're going to talk about my stock picks. Christine had nothing to do with those.
Nope. Sorry.
But first, the market's a little dysfunctional today, so I guess that's kind of topical. So today is like almost an inverse of Friday, because Friday, when we went live on Friday, everything was really super high and everything was doing great. And then just throughout the day, it just went lower and lower and lower, and it even went negative for a bit. And then it ended up higher, but not as high as earlier. So today's a little bit of an inverse because we started out really low, and then things have kind of been gaining a little bit of steam, but it's still pretty negative overall. So, actually, the S&P is now over 3,000. We started out the day at like 2990 or something like that.
Oh, wow.
So now we're at 3,020. So still down about 20 points, about 69 basis points. We were down almost 2% earlier. So this is a huge move.
You just never know what it's going to do.
I know. Even the Dow earlier was below 25,000. Now we're pretty far over 25,000. Still down 262 points, over 1%. The NASDAQ is down 36 points, down only 0.38%, so not too bad for that. And the VIX, which we talked about last time, now Christine knows what the VIX is.
Yes.
Right? It was up a ton earlier, like 15-20%. Now it's only up about 3.5%. So we're around 37 or so for the VIX. We are over 42, I think, is around where it opened. So things are kind of evening out. Volatility is coming down. Just depends what kind of mood people are in. I was thinking about this, and I kicked myself for not saying this last week because I meant to on Friday. So I got, if everyone remembers, not last Friday, but the Friday before, which would have been, help me with dates, the 5th.
Okay, sure.
No thanks to you.
Yeah, it would have been.
The weekend, the Friday, June 5th, the weekend after that, that Friday we had the kind of, I think, 2% rally or so. Everything was kind of going crazy upwards. And that's why Monday I talked about, this momentum behind the market. And so that weekend, though, I want to say, I think CNBC jinxed the market.
Why?
Obviously, that's a joke. But here, let me see if I even saved this email, because I remember looking at this email and saying, that's it, they jinxed it. So they said on June 6th,
that's Saturday.
I know. I said it was the weekend after the 5th. The stock market was right. Will the rally continue next week? You had to say that.
And it didn't, right?
It didn't, no. No. Last week was horrible. Last week was down like 10%.
Like, don't say anything.
I'm like, no, you didn't just say that. Stock market was right. Will the rally continue? That's famous last words 101. Like, don't say that. I just thought that was really funny.
Yeah.
Because I remember when I saw that email, I thought, I want to check back in a week and see if it actually happened. Because that's just, when anyone says that, it's like, it's not going to do what you think it's going to do. So, because almost immediately, Monday was okay, and then Tuesday through Friday was just down. Friday was a little bit up, but now we're back down today. So crazy market times. Volatility, like I said, Friday has risen astronomically back over, almost over 40. It was over 40 earlier, but it was under 28 last week. And so it's just crazy moves in the market, and that's, kind of reminding me back in March and April when we were seeing 1,000-point moves in the Dow every day. Today's not that bad, obviously, but we were down considerably more. We were down about 800 points earlier. So just that's the kind of thing you get with high volatility, and so it's just been pretty crazy. So it's good for option sellers. I'll talk about options later. It's really good for option sellers because you get that high volatility. When volatility is really high, it tends to be overstated, and so it tends to come back towards the mean over time. So for option sellers, volatility is in our favor. Okay.
Oh.
Yeah.
That's good.
Yeah.
See? It's not all bad.
Right, so that's a good thing. It's really good for option sellers. My own account, I was down a bit earlier, and right now, last I checked, I was up a bit, so that was good. A few orders exit out with a profit today, so that was nice. I think
that's good.
Oh, what exited out? I don't even remember now what exited out, but a few... Oh, oil, USO. USO is an ETF for oil. That exited out, and something else I don't remember now. So it's been a pretty good day for me. But what I would think is going to happen this week, and I meant to last week, I wanted to kind of do a prediction, which predictions are going to be almost always wrong. But from where we're sitting right now with volatility this high, and the drop we had Thursday, and now we're kind of trying to find, I think, a new normal. I would expect this week to be pretty flat, honestly. Maybe like up, chopping up and down a lot, but maybe a bit down. But it's just, I think people are kind of trying to find a new normal, where there's a lot of news going on. There have been some increases in coronavirus cases in some different states. Florida, I just heard this morning, is actually back to their 7-day average. So that's pretty positive, I think. So
places are opening, and
places are opening. So there's a mix of good and bad news, and I just think the market's kind of trying to price in everything. And so, right around this 3,000 mark, I think for the S&P is going to be a big range. Kind of is it going to end up above or below? Who knows? But I think that's going to kind of be our center point for a while. So that's kind of what I'm expecting.
Yep.
So, that's that. I think I'm going to get into our stock picks. Let me get our music cued. Sorry, I wasn't ready before.
Of course not.
All right, so just another point against us today. All right, so it is time for our weekly stock picks. So last week, the market destroyed my stock picks because literally almost no stock went up last week. There were some, but Thursday kind of destroyed everything. Like, there were things that dropped 10-20% last week, so that didn't go so well. Big Lots, I'm still holding Big Lots because they're actually up today. Let me see how far up today they are. Let me see. Because they're actually, both of my picks are doing well today. Big Lots is up 5% today, so that's pretty cool. Actually, it's over. I bought it at $35. It's now at $35.35. I know it's funny.
No, sorry.
Hey, it's up. It was down to like, I don't know, 32 or something last week.
Oh, well, then that's good.
Yeah, no, it's up over where I bought it now. I was at a loss for a while. I'm like, oh darn. So I bought it like 35 last Monday, and now it's up from where it was this morning. It opened. Well, let's see. Previous close. Yeah, see, 33.55 is where it closed Friday.
Ah, okay.
See, it's big. It's important. And now we're up 5% today. We opened up. Where do we open up? Actually, we opened up even lower. We opened up at 32.55. So we've had a big move in Big Lots today. So that, and I think, what was it? Oh no, that wasn't Big Lots. That was there was an analyst upgrade I saw for Lennar. So Lennar, that's my earnings pick from last week. When's their earnings? Hang on, let me see real quick. Sorry about voiceover.
I don't care.
Their earnings are this week. I believe is it tomorrow? Let me see. No. Tomorrow, before market opens tomorrow. So Lennar...
I was going to jokingly say tomorrow, too.
Oh, really? Yeah, it is tomorrow.
That's so funny.
So, Lennar is, again, doing really well. Up 3% today. It closed at $59.25 Friday. It was down. I bought it at like $61.14, and it's 1 penny less than where I bought it. So, but I mean, for how last week was, that's pretty impressive, and it's up 3% today. Now, Lennar. Let me see the news headline I got earlier.
Oops.
Do you still have a headphone?
Yeah.
Okay. Let's see. Yeah, Lennar. Citigroup reiterated Lennar with a buy rating, and they raised their price target to $76 from $53. So that's why they're doing so well today.
Oh, wow.
So that's a huge move. And that's before earnings. So they must be really confident about that. And then my new pick today, which I won't... Okay, I'll mention that soon. So that's how our previous picks were doing. Last week kind of obliterated them, but they're coming back really strong. So I'm still holding both of those because I want to see how Lennar does tomorrow.
Sorry.
So that's all right. So this week's picks, I'm going to do the same thing I did with a regular pick and an earnings play because I think that's cool. I don't know. We're still kind of experimenting. So the regular stock pick for this week is the stock ticker is PFSI. It's called PennyMac Financial Services. And obviously, it's in the financial industry, especially mortgage is what they're mainly they do. And let me find I should have had all this open. I do have it all of it open. I just have way too many windows. Okay, so right now they're trading at $39.95. Hang on, let me see what they are up today. They are up today. I know that. They're up already 5% today. Now, they were another one. Credit Suisse upgraded them, or reiterated it, market outperform, and moved their price target to $44 from $36. So, again, really, really big. That gives them some room to grow, or, to grow upwards. And so... PFSI for me is a momentum play. They've been growing really crazily over the last 3 months, despite the coronavirus. So let me see. So over the last 12 weeks, it's like 3 months, they've gained 124%.
Oh, wow.
Yeah, so more than doubled in the last 12 weeks. In the last 4 weeks, they've gained 31%. And even last week they gained, and I don't remember what the percent was, but even last week they gained in the midst of everything that was going on. So momentum, I sometimes I get into momentum. It's hard sometimes because you can get in at the top, and that's bad, when it's about to drop. But with this new upgrade from Credit Suisse, I think that's a really, really good sign, and with the momentum they've had behind them. And despite all of that, let me see, their price to sales is only 1.54. Their price to earnings is only 3.21, despite doubling in the last 12 weeks. Their price to earnings is only 3.21. So for those who aren't really...
Is that good then?
For those who aren't really knowledgeable about fundamental analysis, price to earnings, and it depends on the industry, but price to earnings generally is pretty good under 15 to 20. I mean, some like tech stocks are usually higher, but like a 3.21 is a really, really low price to earnings.
That is low if you're saying 15 to 20.
Right. So that's a really good one. Let me see. Their estimated growth for this year is 141%.
Oh, wow.
So they have a lot of good stuff going on for them. So PennyMac Financial Services, that's my pick for this week, PFSI. My earnings for this week is CarMax, KMX. Have you heard of CarMax?
No. Is it for cars?
It is. I think it's...
I thought I was going to make a fool out of myself.
No. I think... Hang on, let me make sure. I think they do rentals.
Rentals.
I think. Hang on.
I feel bad about my throat.
Oh, I don't care. So... Okay, they sell used
in new cars.
Yeah. So... Anyway, so CarMax, KMX, they have earnings coming up before the market opens on Thursday. Now, last week I mentioned for earnings, I like to go out a week or so. This week I didn't because everything was beaten down last week, so we have a pretty good price on no matter what you're going to buy this week. Mm-hmm. CarMax, so last week, let me see what they did in last week. I feel bad for all the voiceover.
I don't mind it.
So let me see. In the last week, let me see how they did. They had... they went down last week about $5, 95 to about a little under 90. So that's, they were beaten down last week. So that's why I'm getting into them today, because we have until Thursday when they have their earnings. And they're estimated to beat earnings by 331%. Okay, so listen to this. So their previous earnings that analysts were estimating was a loss of 8 cents per share. And right now it's been updated to a gain of 18 cents per share.
That's good, isn't it?
So that's huge. That's why it's such a big surprise rating. Again, I mentioned I'm really big into Zacks. Zacks is the one that has their earnings surprise prediction rating system. So anything above a 0 is really positive. So 331% is really positive.
That's crazy.
During their last earnings report, they had in the last quarter, let me see what it was, they surprised by 16%. So when it surprises, that just means they beat earnings by that percent.
I was just going to ask you.
I figured. I'm on it. So they're currently trading... Well, that's usually outdated. Let me see. Wait, no, that's not what I wanted. They are currently trading at $90.72. They're up only about 0.83% today, so not too bad compared to the others. 5%, 3%, whatever. They're up less than 1%. So that's the one I'm picking for this week for earnings.
We'll see how you do this week.
Yeah, we'll see. And we'll find out by Thursday, so this one's a little closer than what last week's was. So I'm feeling pretty good about that one. That's a big, if it's anywhere close to that, I'm sure it's going to do really well after earnings. So it's always fun to see, when a company has their earnings report and you have all these analysts weighing in, either upping or lowering their price targets, and it's a pretty busy day after earnings. So I pay a lot of attention to that, but we'll just have to see what happens. I'll report back. Well, I probably won't mention it Friday. Maybe next Monday I'll mention it.
Oh, you won't mention it Friday?
Well, just because we don't have the segment. I might
That's
mention it in
true.
passing, but
True.
we'll see. So those are our picks for this week. So just to summarize, PennyMac Financial Services, PFSI, which is already up a lot today. So, and CarMax, which is our earnings play, which is reporting earnings on Thursday before the market opens. So those are our two picks for this week. So now it is time for our main segment. And today we are talking about the anatomy of an option. So this one, and we're actually doing pretty well on time today.
Surprisingly.
I know.
You're not so wordy.
Yeah, that's rare. So
It's because you're getting the hang of it.
yeah, minus our botched introduction.
Well, it's going to happen even if we do it for 20 years.
So that would be a very long podcast. So I wanted to talk about options. So last Monday, in episode 1, stocks or options, we were talking about stocks versus options. And I mentioned, the benefits of options. Basically, they're leverage. You can have control over a greater amount of shares. And the great thing about options, my favorite thing, is you can kind of target your probability of success that you want. So do you want to win 70% of the time, 80% of the time? How is it you want to win, right? So I really like options. Options versus stocks in my portfolio are about, 4-1. I don't have that many stocks.
Mm-hmm.
Okay. But I have a lot of options, and they do pretty well. I enjoy options. I started out, like I said, before with stocks, probably about 9-10 years ago. And then the thing with stocks is you just don't know what they're going to do,
Yep.
right? And so, with options, you can make money no matter if it's going up, if it's going down, if it's going sideways, if it's just doing not much of anything at all, trading in a range. It doesn't matter what a stock's doing, you can create an option strategy for that. So I wanted to introduce options. I wasn't going to do this, but I figured we may as well start from the beginning. I do have a post about what options are on my blog. I will put that in the show notes for this podcast. Just in case you want to read about it too, but I will try to explain it to the best of my ability. Options are one of those things. Okay, so my history with options. When I first got started...
do you mean now or do you mean at very first?
No, with options.
Uh-huh.
I was so confused. And I think a lot of people get like that. They're so confused by options.
Well, it is confusing.
It is. And... there are calls and there are puts, and you can buy and you can sell, and you can have spreads, and you can do all these things with options. And it's just really confusing, and I find a lot of the articles out there just kind of help, but I had to read for I don't know how many hours on how options work. And eventually I just jumped in, and I'm just going to do it. And I remember what the first option I did was now. It was a stock called Celsius Holdings, CELH. I don't know how I just remembered that just now. And I spent about, $400 or $500 on an option.
I remember how you were so scared.
And it was a good lesson because it was I had it expiring in 4 months. It was way out. It was a call option, I think. And, I had 4 months, but after I bought it, the stock started going down. And I kind of panicked because it's oh my gosh, it's going down, it's going against me. The big lesson I learned from that, because I sold out eventually because I thought, okay, well, now I kind of know how this works.
Yeah.
But I'm not super happy with this option. So I sold it, and a few weeks later, it came back up. Now, I don't know where it ended because I didn't keep track of it for that long. But, a few weeks after I sold it, it started going up again. Pretty significantly, if I remember correctly. And so it's sort of like...
Oops.
The lesson I learned was 4 months is a long time. And even today, like, I was looking at some options I have today, and most of mine right now expire on July 17th. And some of them are going against me, and sort of the emotional part of the brain thinks, I have to get out of that. Either should I close it out? Should I adjust it to try to, bring it back into profit, or to, limit my losses? And then I just realized, okay, that's over a month away. That's a long time. A lot can happen in a month.
Yeah.
I mean, it may not. It may not go in my favor in that time, but in a month, a lot can happen.
You have to kind of ignore it for a while.
Right. So it's just, you have to kind of trust the probabilities that they're going to work out.
Yeah.
And if they don't work out, it won't be that often if you do it the right way. Right? So with options, I mean, it can be, because, you buy a stock, let's just say a stock, and then it goes down. Just like, Big Lots I mentioned. I bought it last Monday, $35. It went down to, I don't know, $30, $32. And you can think like, oh, maybe I should sell out. Like, it's going down. It's not going where I want it to go. But today it's up a lot. It's up over where I bought it. So stocks are sort of the same thing. But with stocks, you just don't know what it's going to do, obviously. But with options, you have probabilities in your favor, if you're an option seller especially. So, as I mentioned last week, options are a way of controlling basically, or having leverage over 100 shares of stock. Now, you never literally own, unless you want to, those shares, unless you exercise the option or get assigned on the option, which I'll talk about. But it's basically, you pay a price or receive a price, if you're a seller, on an option contract that says, I believe this stock will go up, go down, whichever way. Right, that's basically, an option's called a derivative product because it's derived off of an underlying stock, right? And so all that means is that you're betting on the movement of a stock without ever really touching that stock. Okay, it's kind of a little bit like, if you bet on, I never did this, but if you bet on like, you ever bet like on racehorses, you know what I mean? You're not actually riding the horse. You're just betting on which one you think is going to win.
That's a really good analogy.
Thank you. I just came up with it right now. So it's a little bit like that. You're betting on where you think the stock's going to go in the future.
Right.
Now, there are several elements to an option. It's not just like, having control over 100 shares of a stock. There are different elements to it. So there's something called a strike price. I'm just going to iterate these first. Strike price. There's the expiration of the option. There's whether the option is a call or a put. And then there's, whether you buy or sell an option. I think that's all the elements of it. If I think of something else, I'll mention it. So, the strike price. Okay, so first of all, let's talk about calls versus puts.
Yeah.
Okay,
That's a good idea.
Yeah, thank you. Now, you know a little bit about this, so if I'm going off track where it's like not making sense, just tell me.
Okay.
Okay, cool.
I'll signal you.
So, call versus put options, they kind of sound like funny names if you haven't ever heard of them before, but essentially it means one thing. The owner or the holder of a call contract. A contract is just an option, it's when you open an option contract, right? So a call option contract just says, I believe this stock's going to go up.
Yeah.
Right. A put contract just says, I believe this option or the stock is going to go down. That's really as easy as it is. Okay. Now that's for the holder of the contract. Now we won't get into sellers yet. We'll get into that a little bit later. But for the seller of an option, it's the opposite, really. essentially. So if you buy a call option, you're saying, I believe this will go up. But not only do I think it'll go up, I think it'll go up at least a certain amount by a certain time.
Oh, wow.
So you have kind of three things. Number one, I think it'll go up. Mm-hmm. Number two, I think it'll go up at least by this much. And number three, I think it'll go up by this much by this time. So direction, distance, you could say, going up or down, and length of time.
Okay.
Right? I think that's a good way of...
That's pretty easy.
Yeah. Direction, distance, length of time. Mm-hmm. So that's kind of what you're saying with options. Put option is the opposite. Where with a put option, you're saying, I believe this will go down a certain distance by a certain length of time. Okay? Just making sure we're... Oh, good. Okay, good.
What?
No, I was just making sure I didn't actually hit any buttons.
I don't think you did.
I didn't. I know. And so that's what calls and puts are. Now, so that's, if you're betting it's going to go up, you're going to buy a call option. If you're betting it's going to go down, you're going to buy a put option. Right? That's basically how it goes. Now, to secure that right, okay, so to secure that bet, you pay what's called a premium.
Okay.
A premium is just, it's like that racehorse analogy. You go to the track and you say, I bet on this horse, and depending on how likely it is that that horse is going to win, you pay a price to bet, right?
Yeah.
That's kind of like what it is. Now, the thing with calls and puts, it's not just a way, now a lot of people do it this way, I do it this way. It's not just betting on a direction. There is... The true purpose of options is to basically secure a price that you want to buy or sell a stock at, right? So, let's say you have a stock that's trading at $100, and you think it's going to go up, but you would love to secure that $100 price. So, if in a month that stock is trading $120, you're going to look really good coming in and being able to buy it at $100. It's like saying, hey, I think this is going to go up, but I would really like to still be able to buy it at $100. Okay?
Right.
And so that's a call option. The call option gives you the right to buy 100 shares of that stock at a given price.
And to keep it.
And, yeah, well, obviously to keep it.
No, I mean, to keep it at that price.
Yeah, you're going to buy it at that price. Yeah. You don't want to keep it. You can sell it higher, obviously.
Well, yeah.
So a call option says, I want to have the right to buy 100 shares of the stock at this price. That's why it's called a contract, because you're basically saying, the seller of the option, you're saying, do you agree to sell me these shares at this price by this date if I choose? Right? So if you have a $100 stock and you think it's going to go up, then you want to say, I want that, $100 strike. That's the strike price. The strike price is what price you want to secure. So if a stock is going up, you say, no, I want to buy it at $100, but I want to do it a month from now. Right? And so I will pay a premium to secure that right to buy that stock at that price. So no matter what it's trading at in 1 month, if it's trading 110, 120, you can buy it at $100. That's the strike price. Okay.
It's crazy.
Yeah. Now, you never have to do that. I mean, lots of people trade options without ever buying the underlying stock. But that's technically what options are for initially. That's what they're meant for. Put options are the exact opposite. It lets you sell a stock at a given price. So if you have a $100 stock and you're like, it's going to go down. And, I own this stock. Let's say I own 100 shares of this stock at $100. I believe it's going to go down in the next month. And if it does, I would like to still be able to sell it at $100. Right? So it's kind of like insurance. It's almost exactly like insurance. And so let's say in a month...
Why is it like insurance?
Because insurance is saying, like, when you buy car insurance, you're saying, if anything happens to this car, then you pay out to fix it.
Yeah.
The insurance company. If nothing happens, I lose that money, but I still have a working car. But if something happens, then my premium bought me the right to get that car restored.
Okay.
Basically. So it's the same thing with stocks. If I hold a stock at $100 and I pay a premium that says, if nothing happens, the stock goes up from here, great. I lost the money, but, we're still good. But if something happens and the stock crashes, if it goes down, I want to have the right to be, made whole on that stock, to be able to sell it at the price I want.
Right, okay.
So it's like insurance. Do you see what I mean?
Yeah. I didn't know how insurance worked, so.
Oh, yeah.
I mean,
I never bought car insurance because I'm blind. So.
Yeah.
But it's like any kind of insurance, And so that's what a put option is. It's basically saying I own 100 shares of the stock, and if it goes down, I want to be able to sell it at this price and still make either a profit or not lose so much. Okay? So it's an insurance. It's insurance against your stock, basically.
That's really cool. That's a cool analogy.
Yeah. So again, so calls give you the right to buy a stock at a given price. Puts give you the right to sell a stock at a certain price. Now, again, you can buy a put and never actually own that stock, but it's just the mechanics of how puts work and calls.
Yeah, I was gonna say.
Yeah, so that's what it is for. Now you have the distance. So a call option. That's again $100 stock. I pay a premium, and it goes up. So when I say direction, you have up. Distance, obviously I need it to be at least over $100, right, for me to make a profit.
Right. Yeah.
But not only do I need it to be over $100, I need it to reach what's called a break-even price. So let's say to buy that call option, I pay, I'm just going to say $5 a share. Okay, so options, you'll see a price like $5, right? It's actually $500 because it's 100 shares, but it's a per share price. So let's say I have, I want to lock in this strike price of $100 that I can buy the stock at, and it's going to cost me $5 to secure that right, to buy that call option. So, but now because I spent $5 on this contract, it has to not only reach $100, it has to reach, what's that?
It has to go up.
It has to reach $105.
Oh yeah, that's right.
Right. Because you have to add in your premium to your strike, that's your break even. So when I say a certain, it has to, you have a direction, which is up, but a certain distance, a certain amount of profit, you needed to go up to $105.
I did not know about distance. I don't think you ever talked about it.
I think I did, just not in this way.
Okay.
If it doesn't go to $105, you're going to lose.
Yeah.
So if that stock goes to $104, technically, yeah, you still, we're right, it did go up. But you're actually going to lose $1 per share because it's underneath your break-even.
Yeah.
See what I mean?
Yep.
Same thing with a put. Okay, so a put says I needed to go down is the direction. Distance, we have a break-even. It's the same thing. You pay a premium to secure that right to sell the stock, and you subtract that premium from your strike price to get your break-even. So
$95.
$95,
Yep.
Exactly. So I need that stock to fall at least to $95 for me to have a profit. Anything below 95 is total profit, right? So let's just think about this. So let's say we have a call option and we buy it for $5 and the strike price is 100, and it goes up, the stock goes up to 110. Great, right? That means
it's over.
we get to buy it at $100 but we can sell it at $110, so that's $10 profit, but we subtract out our $5 that we paid, so that's a $5 profit. Same with a put. If it falls to $90, you have a $5 profit because it's $90. You get to sell it at $100, so that's a $10 profit, but you subtract out your premium, which is $5, and you have a $5 profit. Right? So for calls, anything above the break-even is profit, and for puts, anything below the break-even is profit. So that's what I mean by distance. You have to factor that in. Some people just say, oh no, I think it's going to go up to this price, but they don't factor in the break-even, and so they lose out. Right? Oh. So if it doesn't go up as much as you think it will, you're still losing. And that's the thing about buying calls or buying puts. You have to be really, really correct about your assumption in order to benefit from that. So that's direction, distance, and we have length of time. You don't have infinite time in order for this to happen. You have expirations, right? That contract will expire on a certain date.
Yeah.
So traditionally, with monthly options, it's the third Friday of every month. With some really popular options, they have weekly contracts or weekly expirations, where it's pretty much every Friday, right? That's with the more popular ones. Mm-hmm. And that's a newer concept that, that hasn't been around for that long. But there are always monthly options. Third Friday of every month is expiration. You can't just pick your expiration. You can't just say, okay, I think it'll do this by, June 29th or something. You can't do that. You have to pick an existing expiration, right? So let's say, okay, I think it'll do this by July 17th. July 17th is the third Friday of July.
Okay.
Okay, so, it could do it on July 20th, which is the following Monday, too late.
Oh.
It has to be by the expiration. So you have to be right in three ways for an option for an option to work out. You have to be right in direction. You have to be right in the distance that it goes, and you have to be right in the length of time that it takes to get there. So it's a lot of things you have to be right on. So it seems like, oh, what's the point? I mean, and there is a way to kind of work around that, and we will talk about being option sellers. That might be a good topic maybe for Friday.
Maybe.
Because I think, I don't want to have a whole hour of just talking about options. I think that's a really good introduction to buying options.
Right.
And again, you might think, why would I want to do that? So generally I don't buy options. I usually sell options. So selling options is really appealing because if you ever think, okay, I compared it, I think, to a casino. Was that on the podcast I did that?
Yes. Okay,
so if you go to a casino, you're like the option buyer. You're setting down your chips, you're betting on, whatever you're betting on, and you're hoping to win. You're more likely than not going to win, but you're hoping you're going to win. And you're hoping that your wins, that the amount you get kind of outpace your losses, right? So even if you win less often, you're hoping that the amount you get kind of offsets plus some your losses. Right. So, but the casino is, what they call the house. That's the option seller. That's the one that says, oh, you want to bet? Okay. I'm just going to, scrape off a little profit here, a little profit there, a little profit there. Everything is set up really in my favor if I'm the casino. Mm-hmm. And over time, I'm going to win more often than you are. So that's option sellers. And we're going to talk about that Friday. But sometimes I do buy options, and, I'll talk about certain times it's best to do that. I just want to mention the basics today. But sometimes I do buy options if I really think, if there's a lot of momentum behind a stock, and I think it'll get there within the next couple weeks, or even within the next month, because you can go out more than a month. You can go out to August, September, October. You can go out as far as you want to for the expiration. Mm-hmm. You get to choose that. But if I think a stock is really moving and I just want to jump on that and make a quick profit, usually when I buy options, it's only for a few days up to a week.
I was going to say, how do you know?
Because, it's just like, okay, so I bought an option recently on Chewy, because Chewy was having their earnings a couple weeks ago. And, they were going up pretty good, and their earnings were expected to do well. And so I thought, okay, I'll buy a call option. And so I did, and I profited a good bit from that. I mean, I really made a lot off of that.
Yeah, you did.
But that was only in maybe 3 days, okay? And, like, the day I bought it, the very next day I was up, like, I don't even know how much a percent, like 30%, I think. So options move quickly. And that's the really great thing about them is their leverage. So, you'll have 50%, 100% profits off of options, sometimes more, and often really quickly. So, it's definitely worth buying them if you are really confident about the direction of a stock. But I just want to point out, again, you have to have 3 things in your favor. You have to have the direction, the distance, the profit, and the length of time all in your favor, or else you're going to lose. Right? So it's really good for very specific circumstances. If you're really confident, I really know that this is going to do well, then that's great. And there's a lot more to that, but I think that is a really good introduction to just how options work. So just kind of as a summary. So you're paying a premium as the option buyer, you're paying a premium to open up a contract on a stock, on an underlying stock. A call option is saying, I think it's going to go up this distance, at least above the break-even price, by the expiration date. And a put option is just saying, I think it's going to go down at least this much below the break-even price by the expiration date. The traditional purpose of options, call options give you the right to buy the underlying stock at the strike price you agree on. Put options give you the right to sell an underlying stock at the strike price you agree on, but you never have to ever do that if you don't want to. I only did it once accidentally because I got assigned on an option.
God.
We'll talk about assignment another time. But when you own a call option and you decide to buy the stock, that's called exercising. Or when you own a put option and you decide to sell the stock, that's called exercising.
Both of them?
Both of them are called
Okay.
exercising. It's just saying, I have this contract, I want to exercise the contract to actually do what the contract says, whether buy or sell that stock. Mm-hmm. It's rare. Most option buyers don't do it unless you really want to hold the stock. Okay, most people just buy and sell the actual option contract and make a profit, hopefully, on it. So that's basically how it works. So yeah, that's I think that's a pretty good introduction. Do you think so?
Yes.
Awesome.
I think it's perfect.
That's a good introduction to options. I was trying to find my outro music. I think it's a pretty good introduction to options, and we will talk more probably Friday, unless something else comes up first, but soon. We will talk about selling options and why that is actually almost always the better choice.
Yes.
And so we'll talk about all that. So hopefully that makes sense. We will have this, if you go to possiblepromise.com/live, you can look at our previous episodes, including this one. I'll post later today. And you can leave a comment if you want to. You can check out
/live, even though
live. Yeah, well, that's just where the live stream
okay.
is, and then the episodes are off of that, linked off of that. Yeah.
Right.
And then you can leave a comment. You can see the show notes, whatever. I'm still figuring out how I want to structure everything, but that's how I have it right now. So if anything here didn't make sense, feel free to ask. And if there's anything you want me to cover in the future, go ahead and ask.
Remember, Fridays are question Fridays.
Yeah, Fridays are question days. So if you want to ask Possible Promise, if you want to ask us something for the Ask Possible Promise segment, go to possiblepromise.com/ask, and you can do that there. So I hope that you enjoyed this and this made sense to you. We will see you on Friday for the next episode of a Possible Promise podcast. Thanks, everyone, and have a wonderful week.
Have a good week.
Bye.
Bye.